so I think we can go ahead and get started.
You're waiting
Now that-
for me.
now that we have-
Oh, man.
David, we've completed our quorum.
Do I feel good?
The first item is the roll call.
Yes. Landon Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams,
Present.
David Holly,
Here.
Trey Burke,
Here.
Stephen Carter,
Here.
Derek Challenger,
Here.
and let's see, Johnita Colton.
Here.
Gregory Coleman,
Here.
Perry Wilkes. Yes. John Morrison,
Here.
Brian Birnbaum,
Here.
Jim Whitney.
Here.
And we do have a quorum.
All right, great. So we have 3 sets of minutes to approve that were sent around before the meeting. Hopefully everyone had a chance to review those. Any questions or comments? No? Can I have a motion to approve?
So moved. Second.
All in favor?
Aye.
Aye. All right, the minutes are approved. We have Greystone and Hancock here, with Greystone up first to do the portfolio review. So I'll hand it over to Jim Whitney and Brian Birnbaum. And is Perry with Greystone or Hancock?
He's with John Hancock.
Okay.
He's with Hancock. Thanks, Landon. Jim, does everybody have a copy of the reports, or do we want to share screen?
I did hand them out. I don't know, does everybody have a copy, or should we share the screen? We need a copy.
Well,
Jim, is that the right one? Is that the right one?
Yes.
Okay.
This
No,
one's
sorry.
thicker than normal, I think.
Go over that 1 second.
It might be a little bit thicker. There's more information there.
Is this the right one?
That's it.
Yep.
Did you have to completely redo the deck yesterday morning?
Why, did anything happen over the last couple of days?
Market like today.
We'll talk about,
Up a little bit,
lot of that
pre-market.
stuff. I'm going to have Jim kind of go through the market overview and outlook here, but recognize that with the news and results from a couple of days ago, that the economic data doesn't necessarily change, but and what's going on in the capital markets and what was priced into the capital markets may be quite different than some of the things that we're going to talk about, or could be the result of the election could exacerbate a lot of the things we're going to talk about. So we'll touch on all that stuff. We'll touch on portfolio results. We'll touch on some of the changes we made to the portfolio a couple of months ago, and some of the things we're thinking about going forward. So Jim, if you want to kind of get started, that'd be great.
Okay, so I'm on slide, if you have a hard copy, I'm on slide 5. Brian, can you see that okay?
Wait here.
Yep.
Okay, great. So let's start by looking at the left graph on slide on page 5, and really what we're looking at here is a pretty extreme move upward in the S&P 500, and the bull market is now about 2 years old. Birthday was October 12th, 2022. And since then, the S&P is up roughly 65 to 70% off those lows. We hit a new all-time high yesterday. Markets soared to a record, and that was really based on Trump 2.0 and his spending plans, reduced tax cuts, and reduced regulation. So a more market-friendly environment. At least that's how it's perceived day one. And this has really benefited the Portsmouth portfolio because it looks like the portfolio will grow at a double-digit pace again this year. And that yesterday was the Dow's biggest gain since 2022. I think the thing to keep in mind, though, is at the lows just over 2 years ago, sentiment was extremely bearish. There was this widespread fear that we were going to be entering a recession caused by very aggressive Fed tightening policy. And as we know, that never came to be. The market has really enjoyed a much stronger economy, I think, than most economists predicted. The challenge is on the right, and this is a 10-year treasury. Bond investors, the bond vigilantes, are saying, look, that's all great, but if the economy is growing at 2.8 to 3%, that's a really healthy growth rate. And we've got a Fed that's meeting today and voting on cutting rates, and we'll talk about that in just a minute. But a Fed that's cutting rates into an already strong economy, and a president-elect who is going to reduce corporate tax rates and have a more regulation-friendly environment is pro-growth. Bond investors are saying rates need to be higher, and indeed they are. They're about, now from here, this is 4%. Today they're about 4.5%, so almost 50 basis points higher. And that's a really meaningful number in a short period of time. It's all well and good, but let's look at the valuations, and that's what we're looking at here on slide 6 on the left. This is the market multiple, and what we see here is that the market multiple is fast approaching two previous cyclical peaks, this being in 2021 when the cyclical peak was about 22.5, going back to 1999 when that cyclical peak was 25.5. So market's done really well, but it's very rich, and this forward PE has expanded by about 45% during this time period. And what we really like to see are earnings grow at a pace that supports this PE ratio. So very aggressive expansion of valuations. So segueing into earnings, what we're looking at here on the right on slide 6 is the expected earnings growth rate for the first and second quarter of next year, and you can see it's roughly 13 to 14%. And we'll see how difficult that might be to achieve here in just a second. So if we're looking at earnings revisions, which is this light blue line for 2025, we've got valuations that are extended because the market's done really well and it's benefited the portfolio substantially. But unfortunately, earnings estimates have gone down. So they've gone down from about 280 projected for 2025 to where they are today, which is about 275. We really need to see those forward-looking earnings improve and catch up so that the market can grow into its high valuations. And to get there, we're going to need margin expansion, and that's what we're looking at here on the right on page 8. Operating margins are already at an all-time high, so to get to those 2025 earnings estimates that I showed you previously, we're going to need another 125 basis points of margin improvement, and that's never happened in a soft landing. Now, that's not to say that generative AI won't improve margins and profitability for companies. I think it's quite clear to most professional investors that that will be the case. Our view is that it'll likely be pushed out to 26, 27, and 28 before that enormous amount of CapEx spending starts to benefit other companies. certainly get a lot of questions about the Mag 7, and for those who aren't familiar with that term, it's the Magnificent Seven stocks that have been driving a lot of the movement in the market. That group has started to underperform in mid-September, but the group is Microsoft, Amazon, Meta, Apple, Alphabet, NVIDIA, and Tesla, if you're not familiar with that group. And the takeaway from this slide is, if you look at the dark blue line, that's the year-over-year net income change for that group of 7. And it's been real. It's been powerful. They have absolutely grown their net income. But if we look at the first quarter of 2025, you can see that we're forecasting about 16% growth in net income year over year for that group of stocks versus about 14% for the market. So it's starting to mean revert, and in 2025 there's only 2 percentage points difference in the year-over-year growth. Now our expectations is that continues to widen during the course of the year, but the main drivers of the year-over-year change in income is probably behind that group.
Jim, do you think AI is going to have a significant difference as we get closer to the end of 25 and into 26, as far as what these numbers are showing?
The market is certainly
With the Mag 7?
Yes, yes. The market is certainly counting on the impact of generative AI to start to broaden out away from these companies into a much broader universe in 2026, 2027, and 2028. Yeah, absolutely. I don't think anybody really knows what it'll be, but if you look at the CapEx spending of Google, Amazon, Oracle, they just all just reported, except Oracle, and the CapEx for AI is going to be higher next year than it is for this year. Apple's a little bit more cautious, but throw Microsoft into that mix, and it's somewhere between $30 and $80 billion roughly next year in CapEx AI. So we're still in the heavy spend cycle for that. This next slide just shows the pretty dramatic difference in the 12-month forward PE ratios. We've looked at the United States, which is that dark blue line, but now we're comparing the forward PE to the TOPEX, which is a Tokyo index, the MSCI, which is a European index, and emerging markets. And you can see how much more expensive the U.S. market is than the rest of the world. So this does support the idea of having a well-diversified portfolio because of these high valuations. To date, we must recognize, however, that growth in earnings and revenue for the U.S. has been dramatically better than those other markets, which is why the U.S. has outperformed. It would be appropriate to spend a few minutes on inflation because we've spent the better part of 2 years talking about it with this group. So I'm going to focus on the bottom two charts. The one bottom left on slide 11 is the supercore CPI, and the supercore is a measure that excludes goods prices, food, energy, and housing. And I know that's a lot to exclude, but it's just another way to slice the data. And it really represents about a quarter of the CPI and about half of the PCE deflator, which is the Fed's favorite measure of inflation. And the key takeaway there is it's still running high at 4.3%. And if we look to the right, we're looking at the core PCE annualized, which is the core personal consumption expenditure index. And clearly it was trending much lower than we've experienced in the last 2 years. And this is why the Fed is now in their easing cycle. But we can also note that in the last month, it's up 1.9%. So the 2.6 is a 12-month, and 2.5 is 6-month, 1.7 is 3-month, and then we've got the 1 month. And directionally it has turned. Our chief investment officer, Lisa Shallett, who heads the global investment office for Morgan Stanley, on a call last week, suggested that she wouldn't be surprised if there's a spring back in inflation because of policies of the new president, if President Trump got elected, of course, but also the fact that the Fed is easing into a pretty robust economy. And I'm not sure that's ever happened before. So she's growing a little bit concerned that we're going to see a resurgence in inflation. This next slide addresses questions we get about the housing market, and it just seems stuck. Housing stock just can't turn over, and so what we looked at is the mortgages. And if I can draw your attention to 2024, what we're looking at here is how many mortgages are above 5%, and you can see that is 24%, the green is between 4 and 5, the blue between 3 and 4, and the blue at 22% below 3%. So when you look at all this data in aggregate, what we're looking at now is 75% of the housing stock with mortgages is effectively frozen. And that's because these mortgages are under 5%. The average 30-year fixed mortgage as of yesterday was a little over 7%, about 7.1%. So even if the Fed has the ability to cut rates 100 basis points and there's a corresponding decrease in the 10-year Treasury, which doesn't always equate, by 100 basis points, that's still not going to unlock this housing market. I mean, this is just the fact of financial repression and the Fed keeping rates artificially low for a long period of time, and many homeowners have just locked in mortgage rates that are well below where they are in the market, and they're unwilling to relocate and lock in a mortgage that's possibly double the interest rate that they're paying today. So markets in the U.S. at an all-time high as of yesterday, but what our strategists would like to point out is that really, if we're looking under the current at the consumer, that it's a very bifurcated economy. And we have a significant segment of the consumer market that's struggling. And that's what I'm going to highlight on this slide. So at the upper left, we have cumulative excess savings. And the savings came from government stimulus programs. If you recall, there was a round in March of 2020. There was a second round in December. And then there was another round at the beginning of March of 2021. And also the consumer during COVID just saved because he or she wasn't spending as much, they weren't traveling, they weren't going out, entertainment, et cetera. But as you can see on the upper left on slide 13, this cumulative excess savings has run out. And now consumers are borrowing to meet their needs. And this has become self-evident when we start to look to the right, top right, which is the credit card loans outstanding. It's now exceeded over $1 trillion. As you look below that, the interest rate average is just under 22%, an unbearable 22% interest rate on that outstanding debt. So there's no surprise if you look at the bottom left that we're starting to see delinquencies tick up in credit cards and also auto loans. And if we look at subprime auto loans, those delinquencies are even more sharp.
Is that a concern to you?
It is a growing concern to us, because for the economy to continue to grow at 2.5% to 3%, we need a really strong middle class, and not a lower middle class that is stretched from a financial standpoint. So it's a warning sign for us.
How do you explain that, though, when you've got unemployment as low as it is, labor costs going up, financially, people are obviously earning a lot more, yet we're seeing higher delinquency rates, less savings.
It's the savings rate is much lower than it's been over the last 5 to 7 years. So 4.2% unemployment, which is by most economists' projections is full employment, and we've had wage growth over the last 3 years, probably close to 4 to 5%, but that's also all rolled over. And if we look at the jobs number for last month, I think it was about 11,000. The projection was for 100,000. The prior month, the jobs growth was 243,000. Now, we certainly have about 40,000 or so we can count from the Boeing strike, and then we have a hurricane, which probably impacted that as well. But that was a pretty tough jobs report. And that's exactly what the Fed is going to use today as their support to reduce interest rates by another 25 basis points.
Back to your comment on margin expansion, and your company's going to start, being pressured to lay people off to protect margins or grow margins. Is it that?
No, all I was suggesting is to get to the earnings estimates for the first half of 2025, we're going to need 125 basis points of additional margin improvement on top of record high margins. How they get there through cost cutting, that's going to vary dramatically by company. As David suggested, at some point they will benefit by using AI in their business to the extent it's applicable. So this is a great segue now into the current Fed policy. If you recall, the Fed stopped raising rates in July of 2023. And not that long ago, the consensus was that we were going to get 8 rate cuts. That's the light blue line. That was just September 15th, so a month and a half ago. The October 15th is the blue line, and you can see how much that has shifted. And this is the challenge with a Fed that is very data dependent. It's hard to predict what they're going to do, when they're going to lower rates, and by how much. So it's shifted pretty dramatically. I looked yesterday, well, first of all, today's meeting, there's a 98% probability of a 25 basis point cut. The next meeting is on December 18th, and there's a there's a 67% chance of another 25 basis point cut. And then going out to January 29th of next year, which is a subsequent meeting, the probability of another 25 basis point cut falls to around 30%, and then it starts to fall off. But that's where we sit today, given the economic data that we and the Fed have. That's a consensus. That's what the market is forecasting. So on the right, what we're seeing is a normalization of the yield curve. Recall we had an inverted yield curve for quite some time where the shortest maturities yielded more than the longer end of the curve. That's flipped, which is generally an indication of a healthy economy. That 10 years now, as I said, it's about 4.45. That 2 years about 4.25. So there's about only a 15 basis point spread between the 2 years and 2-year and a 10-year Treasury, but it's healthy to see that positive slope, which didn't exist for quite some time. This slide's busy on 15. There's a lot of information here, and really what it's designed to do is just give you a snapshot of past Fed easing cycles, and you can see they're all very different, and this cycle could end up being much different than what we're focused on here today. The 1995 Fed cycle would be considered a soft landing, very short and shallow easing cycle. And in 1995, the Fed cut twice. They cut 25 basis points in mid-year in July, and they cut another 25 basis points in December of 95. But they were starting with the Fed funds rate, at 6%. But it's a very short cycle. So you can see how dramatically different these cycles are. The consensus is this will be a short and shallow easing cycle. May not be identical to 1995, but that's the closest one that we have to compare. And the last slide, I'm going to focus on, given the election outcome, I wanted to spend a minute talking about it. So the odds of a Trump versus Harris win were on the left, and we all know that really going into the election was considered a jump ball. And really nobody really had a high degree of confidence in the outcome. Trump 2.0, as we sit here today, there's a widespread perception that it will include tax cuts for corporations and a reduction in regulation. So, as we said, the market likes that and rallied pretty substantially. I think the thing that, regardless of the candidate, that we're most focused on is, or one of the things we're very focused on is on the right. And this is the budget deficit. Both political parties, in our view, are responsible for amassing records amount of debt and really haven't taken any meaningful action to reduce that. And we all know, whether it's us personally or a corporation or the government, is that without corrective action, eventually, if there's too much debt, there could be a financial reckoning. And so what we would like to see is some acknowledgement that debt is out of control in this country, particularly for the sake of the next generation, and do something to get it under control. This year alone, interest payments on our debt are projected to be about $890 billion, and that is more than we're spending on defense, just to put it in perspective. So,
Is this budget deficit or national debt?
I'm referring to national debt. This is budget debt, this slide. But whoever would have won the election is going to spend less than they promised because of this.
Just prediction is party agnostic, or does this take into consideration one party or another?
Our concerns are party agnostic. We just want this to come down and have a program in place to at least recognize the challenges that this will present to our country going forward. And the longer we wait, the harder it's going to be. Both parties have different policies, and how those policies ultimately unfold and how they impact the deficit remains to be seen. But what we really want to do is start to see this being addressed. You probably remember in 1989, the debt clock. Some of you might. That was in New York, the debt clock, and everybody was focused on getting the debt down. Personally, I think it might be time for another debt clock.
Doesn't sound like the way you're talking, you'd expect that to happen next year,
Do that.
or in the next few years.
We don't know the new administration's policies, so it's going to be very difficult to know. And neither party really spoke much about it during the campaign. So,
What is it, like 20 trillion now or something?
yep.
GDP's 18 or something?
I guess I was wondering, how does the chart on the right factor into, I mean, I know that that's a longer range chart, I mean, that one goes out to 2035.
Yep.
But is that something that, for Greystone and for the plan administrators, as far as they look at the actual rate of defined contribution, is that something you guys are starting to look at, pricing or putting one against the other, where you're talking about, short-term growth expectations, but then you got this.
I'll turn it over to Jim.
So our valuation, we rely on the long-term assumption of the expected return on assets. So we don't do any, I mean, we can do modeling if you wanted to see what changes in the budget would be. But from a valuation perspective, we're using that long-term assumption. So your current assumption is at 7.25, and that's where we're using to project out the contribution forecast that we'll talk about a little bit later. If there, if you wanted to see what short-term spikes would look like, that would be something we could certainly model to give you an idea of some of the sensitivity around some of those returns. Does that answer your question?
7.25 as a discount rate, is that?
It's the expected return, it's essentially both. So when we discount those cash flows back to get the valuation and liabilities, as of the valuation date, we're using the 7.25, which is the expected return, the long-term expected return assumption on the portfolio.
How's that worked out?
We've exceeded that.
Yeah. I mean, when we look at least over the past 5 years, we'll talk about it in a little bit, we've been tracking pretty close to that assumption in recent history, which I think is saying a lot because 2022 was a pretty rough year, but the past 2 years have been above the assumed rate of return.
Yeah, I think everybody lost in 22.
Yeah, that's right. I mean, it wasn't specific to, right, everyone had bad years and you're starting to recover.
But there's, and I guess we're going to cover this later, there's some sort of smoothing in the model that short-term differences to that expected rate of return don't have a huge impact on your actuarially determined contribution.
Correct. So the valuation uses an actuarial value of assets, which smooths gains and losses over the 4 or 5 year period,
Right.
so that those market fluctuations, you will eventually recognize them, but the function of that AVA, and that particularly worked when we go back, if you think back to 2022, is to give you a little bit more of a predictable pattern of your contributions. So if you have a down year, you don't see a large spike in contributions. You will eventually have to make up for that with either excess earnings or excess contributions if you have those large losses. And then on the flip side of that, in the past 2 years, when we've seen these asset gains, those certainly help, but they get smoothed into your asset value, so you don't immediately recognize those right away either. And again, the function of that is to make it a little bit more of a more predictable pattern of the ABA, so that your contributions, it allows for a little bit easier on the budgeting side, so that, I don't want to say 1 year you're at 11 and then you're at 2 and you go back up to 11, it's much easier to say, 7, 7, 7, or whatever the number is, but a smoother pattern. But we're currently using, that long-term rate is what we're using in our forecast models.
And what is the smoothing range? Is it 3, 5?
It's a 5-year smoothing, so the gains and losses are looking at the 5 years of assets, so essentially the 4 years of asset gains and losses are smoothed in at 20% per year.
John, I don't want to steal your thunder, but the net effect of all of this, the smoothing of the gains and losses over the last several years, the net impact for the current plan year is a slight reduction in required cash contributions. Is that right?
That's correct. So right now the market value is tracking to about 98% of the ABA. So what that tells me is when your market value is below the ABA, that means there are some deferred losses that will eventually be coming in. If your market value is above the ABA, then that means there are deferred gains that have not yet been recognized. Right now, the market value is, like I said, about 98% of the ABA. So it's tracking very, very closely. So what that tells us is over that past 5-year period, we've earned maybe a little less than the 7.25, but very consistent with the 7.25. And that's why you're seeing those two values converge over the recent period.
Okay, any other questions before we start to look at the portfolio?
Jim, let me just make a quick comment. I think it was Mark that asked the question on this chart on the right-hand side, whether the 122% of GDP was contingent upon one winner in the election versus the other. I just kind of looked this up as we were talking. 122% is based on current laws, so it is based on the assumption that tax rates don't change, spending doesn't change based on what is currently embedded in the federal budget, it is that debt is expected to grow to 122% of GDP, assuming no change. There are organizations that scored and measured both candidates' economic plans in an effort to show the impact of their economic plans on this variable in particular. And I'll just tell you, under Harris's plan, debt as a percentage GDP over the next 10 years was expected to grow to 134%, and under Trump, it's expected to grow to 143%. So, assuming Trump 2.0, as Jim referred to it, given that there's an increasing likelihood of sort of unified government, and they push through all of the things that he talked about on the campaign trail, the numbers are probably going to look worse than what you see here.
So this is an optimistic
So it's
outlook.
an issue that is even, the concerns are arguably even more heightened today than they were, before the election.
Brian,
Any
any
questions?
any idea as to when the bond market starts to react to this? And
I think
no
you've
longer
started
buying
to see the bond
savings.
market. Yeah, I think you've started to see the bond market react to this. So there's been some interesting, I'll say, developments really since the Fed started cutting interest rates. So on September 19th, the Fed cut interest rates by 50 basis points. There's another meeting today where there's the expectation, and as Jim talked about, of another 25 basis point cut today, and then again before the end of the year. If you looked at the 10-year Treasury basically right before the Fed started cutting interest rates, although they cut short-term rates by 50 basis points, the 10-year Treasury went up in yield by about 60. And this is before yesterday. There was a massive move in the 10-year Treasury bond yesterday as a result of the election outcome. So pre-yesterday, even though the Fed was cutting interest rates over the last, let's call it, month and a half or so, the 10-year Treasury yield rose 60 basis points. Now, there's two reasons why that could be true. One is economic growth. The expectations for economic growth could be stronger because when economic growth goes up, interest rates tend to go up. The other factor that could be influencing the sort of the repricing that we're in the midst of in the interest rate markets is people's expectation for inflation is starting to ratchet higher. And we think it's more the latter than the former. There's likely a combination of those factors that's driving intermediate and longer term yields higher, particularly on the 10-year side. The other interest, so it's both of those factors that are driving it higher. But the principal, we think, culprit here is that people's inflation expectations are starting to adjust higher. So if you looked at the break-even inflation rate, and effectively that is the best estimate of the market of what they think future inflation is going to be. If you looked at what the 5-year inflation expectation was pre-Fed rate cuts, it was something like 1.8%. So pre-Fed rate cuts, the market was saying, boy, the Fed has got this thing under control, we're going to get down to its level. And then they cut by 50 basis points, and then people started to question whether that was too aggressive. And I think most would argue that it was probably, a bit too aggressive. And so the market started to readjust this inflation expectation. So where the 5-year expectation pre-Fed rate cut was 1.8%, today it's about 2.5%. So you've seen a massive move in the market's expectation for inflation And the 2.5% was yesterday. And I would suggest to you that the current estimate of 2.5% may not even fully reflect the results from the election that we're starting to see, and a lot of the spending and tax cuts that have been proposed on the campaign trail, which may or may not, ultimately, pass and become law. But the market is starting to, the fixed income market at least, is starting to reassess not only the higher levels of debt, but what that means in terms of inflation and arguably potentially higher economic growth going forward too. But Mark, I think it was, I can't remember if it was Mark or David that asked the question here. This is, there's any economic variable or valuations of markets or any of those kinds of valuation types of things. Sometimes the market doesn't care about it until it does. And that, I don't even really know what that means, but sometimes the focus is on real short-term sentiment-y kind of things. But ultimately, these long-term factors, these long-term fundamentals, at some point come home to roost. It's really a challenge to figure out when the shift in focus is going to be on these things that we've been talking about. We do believe ultimately these things are concerning, and the market should be focusing on that. Whether they're going to focus on it tomorrow or the end of next year is anybody's guess. But what our job is to do is to kind of position the portfolio to capitalize on the returns that the markets provide, but be ready to shift and move when sort of the short-term sentiment dynamics are evolving. Is there questions about that?
All right, I think we're ready to get into the portfolio discussion, Brian.
Yeah, I'm going to just I'm going to touch on performance, but I do want to spend a fair amount of time talking about some of the changes we made to the composition of the portfolio. We also do have a specific recommendation for the board to consider as it relates to the benchmark. But Stacy, if we could bring the same deck back up that we were on, I'm just going to touch on a couple of slides.
Which slide would you like,
And
Brian?
then we're going to go to the, I'm sorry?
Which slide would you prefer?
It is slide, give me a second. We can go to slide, we're going to go to slide 20, and then I'm going to come back to slide 19. Of the deck that Jim was
Yeah, the prior deck, sorry.
speaking from.
Okay.
But we're going to come to this one next. Thanks. Well, as Stacy's bringing that up, let me just, in the interest of time, start my comments here. The third quarter was a strong one for the capital markets, equity markets across the globe, and really the bond market as well was quite strong in the third quarter of this year. And I know some of this data and information is a little bit dated given what's gone on in October and the early part of November here. But the U.S. equity market, depending on what kinds of stocks you're talking about, the S&P 500 was up about 6% in the third quarter. That puts us up to 22% for the year. This on the back end of a 20+% return from last year. So by all measures, we're tracking at double-digit, at 20+% returns for 2 consecutive calendar years. I'll say that's unusual to have 2 consecutive years of 20+% returns. It's not unheard of. We had a long string, as we'll all recall, in the late 90s. where markets were generating 20+% returns for multiple consecutive years. And then again, going back to the early 80s, we saw a similar dynamic. Not unheard of, but pretty unusual to have strong returns like we've had over the last 2 years. Small cap stocks did well in the quarter. Russell 2000 was up 9%, but that only puts it up 11% for the year. So a lot of what's driving that, and Jim touched a lot on this is the things that are driving, or the stocks that are driving the strong returns are really those magnificent sevens and the exposure that a lot of those companies have to generative AI and the impact that that's having on their businesses and will likely have on their businesses. Non-U.S. stocks did well in the third quarter. Emerging markets were up just short of 9%. Developed markets outside the U.S. up a little bit north of 7%. For the year, those markets are up in the low to mid teens kinds of returns, and then bonds were up about 5%. That puts it up about 5%, a little bit less than that for the full year period. So by all measures, strong capital market returns across the globe, and that's true for both stock and bond markets. Now in October, markets gave a little bit back, particularly outside the U.S. But with the gains we saw yesterday in the U.S. equity markets, we're positive returns so far for the fourth quarter of this year across at least the U.S. equity markets, the bond markets, given what I talked about, and increasing inflation expectations driving those returns a little bit lower. So on slide 20, here's a quick snapshot of the asset allocation at the end of the third quarter. We're slightly overweight stocks versus our 70% target, with a corresponding underweight to bonds. Nothing material. This isn't a view that was expressed on our part, more of just sort of inertia where the portfolio drifts away from its targets, well within the range specified in the investment policy statement, but slightly overweight to U.S. stocks at the end of the third quarter. If I could ask you, Stacy, please go back to slide 19, one slide prior. Here are the returns for the quarter and for longer periods, up about 5.4% for the quarter, a little bit behind the benchmark of 590. And then for the year-to-date period, as we've discussed, given the portfolio's underweight to some of those biggest cap names in the index, the Magnificent Seven, a lot of that underperformance for the year-to-date period to be attributable to that. I do want to spend a couple of minutes on the quarter's results, and then talk a little bit about year-to-date returns, but I'm actually going to go back to the period ending June 30th, 24, given that it coincides with the end of the plan year. We think when we look at the returns earned by other public retirement systems, this 5.35% return for the quarter, I've seen some preliminary data of the returns earned by other public funds, so a universe of investors that have similar sort of accounting requirements, similar objectives in providing secure retirement benefits to public employees. When we look at the third quarter return relative to the preliminary returns earned by others, keep in mind that this is very much early to have final data, so which is why I'm talking about estimated returns earned by others. That 5.3% is right at the median return of others. So although we're below benchmark here, the return that's generated, at least in the quarter, has been very consistent with the returns generated by other public funds. If we look at the 12 months ending June 30th of this year, again, that coincides with the end of the plan year. It also means that we have more finalized data in the returns earned by other public retirement systems. I generated some numbers down. I'm sorry I don't have a slide that you can see here. But our return for the 12 months ending June 30th of this year was about 12.3%, well in excess of the 7.25% return that is assumed within the work that John and his team does. That 12.3% return was just about at the top quartile of returns earned by other public retirement systems. The top quartile return was 12.8%. We're sort of right there, a little bit below, but we're going to be well ahead of the median's return of 11.4%, again, for the 12 months ending June 30. So we're going to focus on that number. Yes, it's below benchmark, but relative to the returns earned by similar institutions, and these are very large institutions, and some of them are smaller, well above median and just slightly below the top quartile of returns earned by other public funds. We've gone through a review of the investment portfolio. It was really towards the end of the second quarter, and we made some substantive changes to the way the portfolio was positioned. I want to spend some time on that, if I could. Talk about the changes we made, talk about the reasons for those changes, and then we have a specific recommendation for the board to consider. So, Stacy, if we can go to the next step, please.
Oh, there's another.
Great. If we go a couple of slides ahead. One more, right here. Let's go back to the prior one. Okay. So in the early part of last year, you may recall that we took a look at our fixed income portfolio, the way we were positioned, and sort of reevaluated whether those exposures and the portfolio construction on the fixed income side made sense, continued to make sense based on how we expected the future to unfold. And we made a number of changes to the bond portfolio back then. The changes that we made to the bond portfolio were implemented with an eye towards simplifying fixed income portfolio. We had a lot of moving pieces in there and different components that came together to form the fixed income portfolio. What we wanted to do is to see if we can have maybe a more robust portfolio that wasn't as unwieldy and as arguably complicated as the one that we originally had. So we significantly streamlined the fixed income portfolio back then. Those changes have worked quite well for us. On the bond side, you can see here over the different time periods, we're outperforming the aggregate bond index, which is our benchmark there, by about 1.5% over the different time periods here since we've made those changes. We took that same approach on the equity side, again, towards the end of the second quarter and into the early part of the third quarter. Wanted to look at what we had, see if we can simplify and streamline the portfolio, eliminate redundancies, with the overriding objective of improving long-term performance. And so that's what we've done. Those changes have been implemented, as you know. We have the discretion to do that as long as it's within the parameters specified in the investment policy statement, which they are. But I want to talk about the legacy structure that we had and the changes that we made over the last few months. Go to the next slide. So here's what the portfolio looked like at the end of the first quarter of this year. You can see there's lots of different pieces here. There's active, there's passive, there's lots of different kinds of passive exposure. When you looked at just the equity portfolio, this is the legacy structure, again, at the end of the first quarter of this year, about 63% of the portfolio was passively managed, so not trying to outperform the market, but just generating those various index returns over time, and about 37% actively managed. One thing I will say is that there are a lot of different passive pieces that were in the portfolio, and one of the things that we've been talking about internally is, hey, can we accomplish the same stuff and just kind of consolidate some of the passive that we had? And ultimately, that's what a part of what we've done through the restructuring. Can we go to the next slide, please? Here's the historical performance of the various asset classes. Again, this is the legacy structure. So we break it out by different components here. We've got the U.S. stock line, developed non-U.S. stocks, and emerging markets. And you can see, by and large, the U.S. stock portfolio generated, decently good absolute returns. 13% over 5 years, 13% since discretion. But they've generally lagged the Russell 3000 index. I think a lot of that can be attributed to the fact that we didn't have as much exposure in the Magnificent Seven, and we've discussed this in the past. We've preferred, given the weight of those names in the index, to be a bit more diversified, a bit more less concentrated in those names. And it's really been those names over the last 5 years or so that have driven the strong returns of the equity markets. Everything else has generally lagged those names. And so it's not surprising to us to see that those returns lag somewhat, although strong absolute returns. On the non-U.S. equity side, recent returns have generally trailed a bit, but long-term returns were quite good, outperforming over the last 5 years by almost or a little bit more than a percentage point, and really since October of 2018, outperforming by over a half a percentage point per year over that period. And then emerging markets have been, sort of a weak spot as well. When you boil it all together, we show the total stock returns here. We show them relative to two indexes. One is our current benchmark, which is this thing, MSCI ACW Index. That stands for the All Country World Index. It is a consolidation of U.S. and non-U.S. stocks at the various weights that those countries represent in a broad equity market index. It tends to focus on the larger cap names in those markets. There is a different benchmark that we're showing here, which is the MSCI ACWIMI. That stands for the All Country World Index, the same as the one above, but the IMI stands for Investable Market Index. What that means is it includes the smaller cap names in the global equity markets that are excluded from the index above. The reality is the way we invest, the way we think about diversification, the way we think about putting portfolios together is much more in line with this investable market index than the index above it. And the reason for that is because we want to avail ourselves of all kinds of stocks, not necessarily focus on just big companies or small companies. We want all of it in our portfolio because over long periods of time, that's how you optimize your risk-adjusted return. But what happens then is over shorter periods of time, like we're going through right now, when the biggest companies in the index or around the world are doing the very best, you can get some distortion in terms of performance. And you can see, just comparing those two indexes, in some periods of time, the return can be dramatically different when you look at those two index, and it's driven solely by the inclusion of those smaller company names in the IMI index and the exclusion in the other index. When you look at our returns relative to that index, in recent periods, we've underperformed, but over long periods of time, we're smack dab on that index. Again, and I'm going to show you some charts here in a minute, but it's the way we invest. It's the way other institutions invest too, right? And so when I get to the end of the presentation here, the recommendation is going to be, hey, let's consider changing the equity piece of our benchmark from this large cap focus index to one that's much more broad. And I can assure you we're not suggesting that we go back retroactively to change it, but going forward, we think it's more reflective of the way that not only we invest, but the way that other public retirement systems invest as well. We can go to the next slide. So here's what we did. I showed you on a prior slide, we had a bunch of passive strategies, we had some active strategies. We simplified the overall structure. In the U.S. equity markets, we consolidated, I think we had two passive strategies. We had a growth and a value into one. This S&P 500 index, it represents 50% of our assets there. And then we transitioned away from a couple of the active managers we had, I think, one active manager, and we put in an active sleeve for a small cap growth manager in the U.S. and then a small cap value manager in the U.S. And we're equal weight to those two kinds of active strategies. On the non-U.S. stock side, we've changed a little bit the passive structure. We've moved away from passive exposure in emerging markets, but it's very similar to the structure that we have in U.S. equity markets. We put in place a growth-oriented manager and a value-oriented manager, both in developed markets and emerging markets as well. And then the last thing we did is we introduced a global equity manager. So a manager that scours the world, find the very best opportunities, regardless of whether they're domiciled here in the U.S. or Japan or UK or wherever they may be. So those are the changes we made. Importantly, we kept the passive exposure constant versus what we had. So we're still the majority of our assets are passively managed, 63% of those assets. But we've changed the composition a little bit of the active exposure. We've moved away from what's referred to as core active exposure, managers that might be growth or might be value, to two managers in each broad asset segment, one focused on active value, one focused on active growth. I'm going to show you some charts here that the exposures change a little bit, the risk profile changes a little bit, but we think this is much more streamlined, avoid some of the redundancy that we had in the portfolio, particularly with respect to the passive exposure, and positions us well for returns going forward. So if we can go to the next slide. There's a lot of numbers here, a lot of bars here. The point here being, the first two bars, the first one, the dark blue one, is the old equity structure we had. The light blue one is the new structure we have. On the left-hand side, we're looking at the different capitalization ranges of the market. And here you can clearly see what I was talking about, the difference between the all-country index and the all-country IMI index. If you go all the way to the bottom on the left-hand side under small cap.
Is the dark blue is the dark blue the new?
Current.
No, yes, sorry. Yeah.
I thought so.
The dark blue is the current, the light blue, I misspoke.
Okay.
The light blue is the old structure. But if you go all the way down to small cap, here you can see pretty clearly the differences between those two benchmarks. That third one under small cap that shows up 2%, that's our current benchmark. It's got 2% small cap exposure. Whether you're talking about the legacy portfolio or the new portfolio, we've got 7% small cap exposure. So we're perpetually underweight. That's a big driver of the underperformance that we experienced on the relative to the benchmark. When you look at the IMI exposure, it's about 12%. So again, it's more reflective of our benchmark. Admittedly, we're underweight small caps relative to that benchmark. But we're comfortable with that, particularly with a lot of the things that we're talking about, maybe a little bit more cautious on equity market returns starting in 25, given a lot of the things we talked about. But it's much more reflective of the way we invest, much more reflective of the way other institutions invest as well. The chart on the right-hand side on this page just looks at the different regional exposures. You can see here, there's not huge differences in terms of the composition of those indexes, and not huge differences in terms of regional exposure from the changes we made and the restructuring of the equity portfolio versus the way we currently have the portfolio invested. Arguably, we increased our U.S. exposure slightly by about 2 percentage points. You can see that on the top at 64% versus the legacy portfolio, it's at 62%. So not substantive changes, I would say, in terms of the overall exposure. For the regional exposure in particular, it's important to keep in mind that with the addition of a global equity manager, that active manager that can scour the globe to find opportunities, that is really what's going to dictate whether we're overweight U.S. stocks or underweight non-U.S. stocks. We're putting that decision with an active manager. That doesn't mean that Jim and I can't do things that would increase our non-U.S. equity exposure or U.S. equity exposure if we thought the opportunity was compelling. We just don't feel like there's a terribly compelling opportunity to take that bet right now. We go to the next slide, please. Here's just some different portfolio characteristics. Again, we're looking at the portfolio as it looks like today versus what it was prior to the restructuring, and we're showing both of those benchmarks. Our portfolio, at least on a price-earnings ratio, which is that second row there, is a little bit cheaper than what the portfolio looked like before, the legacy structure, and cheaper relative to what either index looks like. The other thing I would say is this return on assets. This is a measure of the quality of the portfolio. So are the companies we owning generating strong returns on the asset base that they have? And you can see ours is high relative to the benchmark. And that just is a measure of this quality factor, owning good companies, owning companies that have low levels of leverage, owning companies that have good management, owning companies that have pricing power in the market. Whenever you see companies or portfolios with higher return on assets, it's indicative of this. It's a quantitative way to talk about this notion of quality, which I know we've talked about in the past. The last thing I want to talk about on this slide is this thing called tracking error. So we're showing it relative to the current index, which is the ACWI, and then relative to the other index, which we're going to propose when we get to the end of this. The way to think about tracking error is it's a quantitative way to say how different will our portfolio's return in the future be relative to that benchmark. So the way to think about, under the current Portsmouth portfolio, a 1.24% or a 1.53% tracking error is in 2 out of 3 years, we expect our portfolio's return to be within that margin of the return to the benchmark. So at 1.53%, if the index is up 10%, let's say, our portfolio's return in 2 out of 3 years is expected to be 10% plus or minus 1.53%. Okay, does that make sense? Okay. Let's go to there's just a few more slides here. Here, I'm not going to go through this. Here's the active managers we have, a couple of bullet points on their approach. I would say by and large, the active managers we have a bias towards are those quality managers that have managers that invest in quality companies. Sorry. And the reason for that is we've talked about this in the past, and we can show you data over long periods of time. Those quality kinds of companies tend to outperform the market. So companies with low levels of debt on the balance sheet, companies with strong management teams, companies with pricing power and strong brands in the marketplace tend to outperform the market over long periods of time. Doesn't mean they outperform over every period. And in fact, we're in really over the last 3 or 4 years in a period where these kinds of companies have not done as well in the broad equity markets. But over long periods of time, it is a factor that generates higher than benchmark return.
Brian, what do you consider, give me your definition of long period of time. 10 years?
It really is, yeah. I mean, at the low end, it's probably 5, but some of this stuff can take a decade or longer to play out.
Okay.
Yeah. Go to the next slide, please. So here's ultimately the recommendation, and I sort of alluded to it. Our current benchmark for the 70% that we have invested within our total fund benchmark is the MSCI All Country World Index. It's a capitalization weighted benchmark that includes stocks from around the globe, regardless of whether they're in emerging markets or in the U.S. or developed markets outside the U.S. When MSCI puts that index together, what they're really looking to do is capture 80 to 90% of the investment opportunities around the globe. And what it tends to do is it excludes the smallest companies in the index, and we talked about that. I showed you some charts on that. Our recommendation is to change that to the IMI index. And I have here effective September 30th. We'd actually, given that we're halfway through the quarter here, suggest if you're supportive of it, that benchmark change be made at the end of the year. And the primary reason for that benchmark change, again, we're not talking about going back and changing the benchmark retroactively, but it's more consistent with the way institutions invest, more consistent with the way we invest. It's broad, more diversified than the current benchmark, and represents a sort of the totality of the opportunity set that we're investing in. And again, it's very much more consistent with the way other public retirement systems and really broader institutions invest as well.
Can I ask a question here?
I'm going to stop. Sorry.
The suggested change, Morgan Stanley manages the portfolio for a lot of different entities. So is this a philosophy for Morgan Stanley, or is this something that's, as an individual Portsmouth investor, is this something that best for Portsmouth?
It is the way the majority of institutions benchmark and invest. And that includes Morgan Stanley clients. It includes clients that we don't work with around the U.S.
So it's a Morgan Stanley philosophy change.
It's not necessarily a Morgan Stanley philosophy change. It is a change to reflect what is more common in the marketplace.
So what's the evaluation period to say, yeah, this is working great or this is not working great? How do we work through that?
We all talk about, and this is any consultant or advisor you work with, it's all about sort of long-term performance generation. That is, in reality, that is ill-defined. In practice, what that tends to mean when you talk about long-term performance expectations is sort of a 5 to 10 year period. Now, we've underperformed a benchmark, admittedly. A lot of the reasons for that is, well, some of the reasons for that is because the benchmark we have doesn't fully capture the way that the portfolio is put together and the opportunity set with which we're investing. But the other important thing, I think, to keep in mind, too, is when the rubber meets the road, when you put all these things together, and you compare the returns that we've been able to generate versus the returns that other institutions have earned with the various advisors and consultants that they employ and the various philosophies and ideas that they have, our returns, in many cases, are in the top 25% of returns that are earned by other public retirement systems. So the long-winded answer to say, there's lots of things that go into evaluating performance. Yes, it's performance relative to benchmarks, but it's also relative to what others are earning, and so I think, and relative to the risk incurred. So I think a lot of factors come into play here. I can appreciate that's a little bit of a wishy-washy answer, but the reality is there's no best practice in terms of the very specific and formal metrics with which you judge results. It's a combination of all these different things.
Can we continue to get, as we move forward with whatever change we actually end up making, can we continue to get what our portfolio return would look like if we stayed where we were versus where we would have been if we went with the index versus the IMI index?
Yeah. So let me just make one quick comment, and then I'll talk a little bit about sort of expectations for the future. Whether you agree to change the benchmark from the current benchmark to the IMI or not, we're comfortable with the portfolio that we have in place.
Right.
So we're not going to change the way the portfolio looks based on the decision to change the benchmark. Our only suggestion is to change the benchmark because it's more reflective of the practice of others and the way we invest. So what does the inclusion of small cap stocks mean over a long period of time? When I talk about long period of time, this is well beyond 10 years. When you look over 20-year and longer term periods, small cap stocks are expected to outperform or generate a higher return over a long period of time than big cap stocks. They're more volatile, and because of that, investors require a higher rate of return from it. So I would argue, looking forward, because there's more small cap stocks in that benchmark than there is in the current benchmark, that return should do better. Now, I'll tell you that really since the global financial crisis, and this is 12 years now, or longer, small cap stocks have dramatically underperformed the biggest companies in the U.S. in particular. So we're in a period where you don't have that dynamic where small cap stocks are generating higher returns. But the theory says, and the textbooks will tell you, that because of that higher level of volatility, we should expect a higher return, and we do. It's just that it could be over distinct and shorter periods of time. that may not actually be how it plays out.
Okay, thank you.
So I did have a brief discussion with Brian about this, and this is a sort of not a big change in the grand scheme of the portfolio, but it is a little bit of an asset allocation decision of, do we want the benchmark to reflect the full opportunity set of all equities available, across the globe, or do we want a sort of, the existing is a slightly marginally narrower opportunity set for them to invest in, and he's already said that difference is that existing benchmark doesn't capture some of the small cap stocks.
Right.
Do we want, and Morgan Stanley's already said they're not going to change how they're actually investing regardless,
Right.
but do we want them judged against the full opportunity set or the narrower benchmark? I can say that I think it's a reasonable ask, and I'd be okay with this change, but certainly open to whatever anybody else's opinion on the board or staff is on this. I don't think this is a case of Morgan Stanley trying to sort of play games with the benchmark. I think it truly is what Morgan Stanley believes is the best benchmark for us to be using. And I can say that other, investments that I have for my day job, we use this same IMI benchmark, and it's probably equally used, if not more widely used than the current one that we have. So I'm in favor of it, but I don't think it's a huge change either way. If we stay or we make the change, I don't think it's going to have a big impact on our actual portfolio performance. It's just how we judge that performance.
I'll have a vote in this. I'm just interested in seeing, as we track forward, what both will still look like.
So as I said, it's going to come down to, over the last 10 years, or maybe it's 12 years that Brian said, small cap stocks have not outperformed large cap. So the historical returns for that ACWI benchmark versus the IMI, the ACWI's outperformed because it doesn't include those small caps. Going forward, anyone's guess. I guess we would want to leave that up to the professionals and the active managers to decide whether or not we should be investing in those small cap stocks, regardless of the benchmark. It can be an active decision of the managers to underweight or overweight the sort of amount invested in small cap versus large cap.
And Landon, just to maybe put a little more context around this issue, I said in theory, over long periods of time, small cap stocks really should do better than large cap stocks. I went back, and admittedly, this is just the U.S. equity market. So when there's data that exists that you can go back to 1926, right, and see what the returns of the various components of the U.S. equity market have been going back there. That's almost 100 years. So it's hard to argue that isn't a long period of time. When you compare the return of the S&P 500, which is sort of a broad measure of large cap stocks in the U.S. relative to small cap stocks, something like the Russell 2000, and Russell 2000 doesn't go back to 1926, but there's some providers out there that create different indices of companies that were small going back 100 years. You look at the difference in return between those two indexes. Small cap stocks outperform large cap stocks by something like 1.5% per year. That might not seem like a lot, but when you compound that over 100 years, it results in massive amounts of wealth differences between those two investments.
Landon, I'm a little puzzled while we're having this discussion anyway. A few years ago, this board authorized Greystone to have full discretionary of the investment. So am I missing something, or?
It
You
is,
don't need to even approve this because it's up to Greystone.
they cannot change the benchmark that they're judged on.
And that's what
They
they're
can
asking
change the
to do.
portfolio, but not the, sort of the measuring stick is on us.
What's being invested is
Yeah,
it's going to remain the same.
and David-
It's just how you judge it.
David, sorry.
Go ahead.
So in
Yeah.
the,
I was
in the
just gonna say,
investment,
To be clear, we've made all the changes we've wanted to make. Nothing has held us back from making those changes. The board owns the investment policy statement. In the investment policy statement, it talks about the benchmark. That's why we're coming to you today, is because if you agree with the recommendations, it would require a change to the investment policy statement, which we cannot make unilaterally.
Okay, I'm with you.
Brian, what is the percentage of existing municipal clients that are now using the IMI?
So there's a lot of different benchmarking practices out there. Our approach is to keep it simple, is to say when we bubble up returns at the total fund level, let's use the broadest indexes out there that are available and have less components to the benchmark than more. So historically, that has meant 70% is in this all-country index, 22% is in the Bloomberg Barclays U.S. Aggregate Index, and there's 8% in alternatives that comes together to form the benchmark. For those municipal plans that follow the same approach of keeping it simple at the total fund and use, for example, a single benchmark representative of non-U.S. equities, the majority of those plans use the IMI as the benchmark to measure the performance on the equity side. The other approach is some use a U.S. equity benchmark, some use a non-U.S. equity benchmark, and then put those two together in a way that represents how much they have in each of those different regional exposures. When you look at the U.S. equity, the most common benchmark is the Russell 3000. That has a lot of small cap stocks. They've got about 10 or 11% in small cap stocks. And then for the non-U.S. equity, it tends to be this IMI. So the majority, the clear majority of institutions, whether you're talking about public retirement systems, whether you're talking about corporate defined benefit plans, whether you're talking about endowments or foundations, they have within their benchmark exposure to small companies. And the way we've got it right now doesn't really have that.
We need to vote on this.
we would. Does anyone else have any questions or comments? Do you think we should vote?
I'd like to make a motion that we vote to change the benchmarks for Greystone's recommendation.
I would agree.
All right, all in favor?
Aye.
Aye. Any not in favor? Okay. It's approved.
Great. Thank you all. There's another slide. I think we covered a lot here. I'm happy to answer any other questions anybody might have. But that's all I had for today.
All right, well,
Brian, we're counting on you to make us 50% on our money now.
with this new
The benchmark. That's the new benchmark.
Yeah, we're going to switch to an absolute return strategy. It is 50%.
50% absolute. All right, we're on it.
All right, well, thank you, Brian. Appreciate it.
Thank you.
And hopefully, do we only have till 10:30? Hopefully, we have enough time for John to get through his material. Sorry. I think
No, you're good. I think I'm
Greystone
fine.
went a little bit long.
No, it's not a problem. I didn't have any printouts, so, if you need me to change that for the next presentation, I'm happy to. But for now, I'll share all the material on the screen. You mind if I steal just your clicker here? Let's make sure this works. I think the other kind of benefit, this is all very similar to information that's been prepared in the past, and as we went through, you had a strong market year, so I told Jim on the way over that makes my job a lot easier of telling you, just repeating some of the good news that we're aware of. So I'd like to start with a brief overview of the systems here. You have the two systems, the two retirement systems, the fire and police and the supplemental. Both of those have been frozen for participation for at least about 30 years now. So what that means is your current actives are not coming into the system. We'll show the data in just a few slides, but basically your entire system now is participants that are in pay and receiving benefits on a monthly basis. Those benefits are paid out under 3 circumstances, so retirement, disability, and death is when participants or their beneficiaries will receive money from the funds. Of course, that doesn't work.
I'll do it.
All right, can we just go, next slide then, please? All right, brief overview of the fire and police system. Retirement benefits are payable at the earlier of 20 years of service or age 50 with 5 years of service. The benefit structure is this tiered structure. So participants earn 3% of their final average compensation for their first 20 years of service, 2% for the next 5 years, and 1% of final average compensation for years after 25. The final average compensation is the average of the highest 36 consecutive months of compensation for the participants prior to their retirement. For participants retiring prior to the age of 65, there's an additional $200 monthly supplement that they get in addition to their accrued benefit. The supplemental system is structured somewhat similarly, retirement with 50 and 5. Rather than that tiered structure, participants earn 2% of their final average compensation per year of service, and similar $200 supplement for participants retiring prior to 65 until age 65. I think we're both clicking. I think this, no, we're good. Sorry, that's my fault. A couple of definitions before we get into the numbers here. We talked about the actuarial value of assets. So that is a smooth value of assets where the gains and losses in any period are deferred over that period to make that the value of assets a little bit more predictable on an annual basis. The actuarial accrued liability is the valuation that we perform annually. So for each participant in the plan, we project out a stream of payments for those participants over their lifetime. We take the stream of payments for all participants in the plan, and those are discounted back at that interest rate, the 7 1/4, to give the value of the liability as of the measurement date. We can compare the value of the assets to the liabilities. The two main measures we use are the unfunded actuarial liability, so that's just the dollar difference between the AVA and the actuarial liability. And then you can also look at that as a percentage. And I think both measures are useful in determining the position of the plan and the health of the plan. The actuarially determined contributions, that's, I think, probably the main number that you're all here for today in terms of when we do that evaluation. So on an annual basis, we update the census, recognize any gains or losses that would have occurred during the year, reflect the update in the asset value, and determine this actuarially determined contribution. There are two components to the actuarially determined contribution. The first is the normal contribution. That's the benefits that your active members are currently, the present value of the benefits that your active members are accruing over the upcoming year. That number, there's, I think, 8 current actives, so that number is very immaterial to the overall contribution in the plan. The main driver of the contribution is the unfunded amortization of your unfunded liability. The current period for that amortization is 12 years. We amortize the unfunded currently over a 12-year period, and that trends down annually, once a year, so that we're phasing that down in 1-year increments. So we expect under our valuation assumptions that over the 12-year period, you'll slowly fund that unfunded liability. At the end of that period, you would expect a fully funded plan under those baseline assumptions. The two key drivers of the liability are that discount rate, that's 7.25%, and then the mortality table that we're using to determine mortality in the future, which affects benefit payments. The fund, or at least from the funding perspective, has followed the IRS funding mortality, so that's what corporate sponsors are using. So we've updated that for the annual update. Any questions or comments on those terms before we charge ahead? All right.
Oh, I'm sorry, early retirement at 50 years old, that's paid out, how many months is that?
It would be for the life of the participant, so participants that are, if you were to retire at 50 and 5, I believe the benefits are reduced for early retirement, but then that would be paid out over the lifetime of the participant.
Thank you.
So here's a summary of the plan participants, say kind of the foundation of your evaluation. Because of that closed plan, we have no new members coming in, so that's why you're seeing almost a non-existent active population. And the majority of where the liability lies are these participants that are currently in pay, currently receiving benefits from the fund.
Go back, let me see those numbers one more time.
Sure.
Okay, thank you.
No problem. When we look at the cash flow of the fund over the 5-year history, I think the key thing to note here is because your system is primarily or almost entirely inactive with participants receiving funds, that benefit payment number, so in the second row, represents a significant portion of your assets on an annual basis. The funds that you have are to pay out those benefit payments. Those funds earn money on an annual basis, and then you're also making annual contributions. That gives us that net cash flow number. The thing that we like to point out is a negative net cash flow does not necessarily mean that the fund is underperforming. Because those benefit payments are pretty significant, when we look at the projections in a little bit, we actually expect small negative cash flows year over year. But the expectation is that even though we have a negative cash flow on the asset side, that the liability is shrinking smaller than the assets. And that's where you see that improvement in the funded status over the projection period. For the year ending 6/30/2024, we did have a positive cash flow. And that's largely a function of the strong asset returns we had over that period. But if you go back a year, the negative cash flow does not necessarily indicate that you had a bad year. You actually had a good year in 2023 as well. That negative is just really a function of the high benefit payments.
John, why is the payment benefits higher in 2024 than it is in 2023? We have a shrinking group of payees.
Correct. This reflects, we've included in this that the one-time supplement that was paid out, I believe it was in July of last year, to those retirees. And that's actually why the contribution is a little higher. I think, I'm jumping ahead. I'm way jumping ahead. All right, I'll get there in a little bit. Sorry, I'll go back. But the actuarial determined contribution for the year, I think, was like 8.1 or something like around there. So it was 8.4. So the 9.8 reflects that you funded those additional benefits. They go in as a contribution and immediately come out as a benefit payment.
Is that $1,500?
Yes, correct.
Now, I heard something that's going to occur again this year. Is that true?
It is.
Has it already occurred?
It has not gone out. We are targeting a payment date of that of December 1, and we're working towards that
Or is it
currently.
coming out of this money here?
You fund it as it's paid, so it's not going to come out of the fund. We'll make a contribution equal to the amount. So when we look at this next year, yes, you might see either a slightly less drop in those benefit payments because we'll include the fund. But when we look at the measurement of where you're contributing, we don't reflect the additional payment because, again, that comes in and goes out at the same time. So it's not reflected against the fund.
There's a contribution then to the fund for the equal amount that's paid out for the additional money.
Correct. Yes, exactly.
How does it work for those that are not in payment status? They just miss out on that?
Yeah. The supplement is, yes, it only goes to those participants currently receiving benefits.
You have to be retired,
Correct.
not anticipate retiring.
Yeah, because it's like, it's almost, I don't know, could be look unfair, because like, then when they retire, it's like, I didn't get, you chose not to do $1,500 when I retired.
That's a possibility.
That is a question I had. With the casino influx of money, is it safe to assume this may be something that's done on a regular basis?
No.
Okay. Pretty much answers that question.
Okay.
Nope.
This is an overview of the assets for the system over the past 3 years. We've mentioned the two strong returns in 2023 and 2024, the periods ending 6/30/23 and 2024. So this is over the fiscal year, so from June 30 to June 30. And then the other aspect that we touched on, there was an earlier question about this, that the market value, when we see that tracking closer to the actuarial value of assets, what that tells us is over that prior 5-year period, that the funds were earning very closely to what we expected over that period. And which is honestly, I think, saying something, given that in 2022 we lost 16%. So those 2 years subsequent have really helped close the gap that we see between the market value and the actuarial value. But the actuarial value is designed to smoothen those returns, to give you a little bit more of a predictable pattern for budgeting, really, and recognizing that eventually you will recognize those returns, but you don't necessarily need that in the year that which they occur.
We need at least a couple more years of good returns.
Well, once we hit the 50% benchmark, we should be pretty solid, I think, going forward. Here we show the ratio of the assets to the liability. The number at the bottom shows the funded status, so the percentage of assets to liabilities. This is on that actuarial value of assets basis. And so what that AVA does is keeping that funded status relatively level over the period. And I think this is in line with what we've expected. As I mentioned, we expect those negative cash flows. So really, in the short term, the contributions that we're putting in the returns are really expected to maintain that funded status. And then as we get closer to the end of that 12-year period, that's when you'll start to see incremental improvements in that funded status. This is another measure of looking at the funded status. So in terms of, other than the percent funded, we can look at the change in that unfunded liability. And we can see that over the most recent period, that dropped. Last year we were at $73.9 million. The unfunded has come down to $67.5. Again, this is based on that actuarial value of assets. Below, we've shown the unfunded on the market value. And they're very similar, again, because that market value is tracking pretty closely to the actuarial value of assets.
So like the funding deficit is more important than the actual percentage.
Yes, I would agree. I think the percentage gives you a measure where you are, but ultimately that unfunded is what you need to make up with through either contributions or potentially excess returns. This slide is a reconciliation. So this is on the market value of assets. So this doesn't reflect the smooth value that we use when we determine the actual determine contribution, but to show you how the plan is moved on the market value from June 30 to June 23, June 30, 2024. So at the beginning of the period, you had about 195 in assets, 282 in liabilities, for a deficit of about 87 million, or funded status of around 69%. As we go through those line items, the interest cost represents essentially the time value of money. So the actual liability is a present value now of those future streams of payments. The interest cost represents the expected growth as you lose essentially a year of discounting for those future years of payments. So we expect the liability to grow roughly about 20 million a year. And then you see the benefit payments to retirees are about 30 million a year. So assuming no gains and losses year over year, you would look at your liabilities are expected to decrease about 10 million a year on an annual basis. I'll stick in the liability column. When we update the census year over year, we reflect participant changes This year, that produced a small liability gain. Some of this gain is also driven by the update in that funding mortality table. That funding mortality table was roughly about a 1% gain. So the demographics are really a very small gain or loss. I think this year we had a small gain. I think for the prior years we've had small losses, which we would expect. Not a lot of movement in your liabilities because of that primarily in-pay population. I think the other thing that tells us is, given that we're not seeing large gains and losses on an annual basis, I think pretty comfortable with the mortality table that we're using. If we were seeing swings one way or another, then that would be an indication that we might want to review the mortality table to see if something maybe better fit your population. But I think this tells us that we're pretty consistent with the mortality table that we're using. On the asset side, just I'll go back and reconcile the 30 million payments to retirees. That does include the additional supplement payment. Contributions from the city, 9.9 million, the strong investment return, and that's where that positive cash flow that we're seeing there. When we get to 9/30/2024, so this is the most recent quarter end. I won't go through everything line by line, but we've seen a decrease in that surplus, so another strong quarter that was discussed earlier. So an improvement in the funded status from 73% to about 75%. Okay. This is a history of the funded status going back 10 years. So here we're going back to the history on the actuarial value, or that smooth value of assets. And I know it kind of looks like it's bouncing up and down a lot, but that range, so on the right-hand side, the funded percentage, is a pretty narrow range. So really over the past 10 years, you've basically been between 70 and 75% funded. So what that tells us is, I think that's expected based on where we are with the contributions we're putting in, and that the actuarial value is kind of keeping that smoothing. But we do see in recent years a decrease in that unfunded liability, so the gap that you need to make up in those future periods.
Question.
Yes.
What was driving that increase from 2015 to 2019 in the unfunded liability?
That's a good question. I'd have to look into that. My guess is probably a function of either market conditions at the time, or it could be some of the smoothing. Again,
No, I know a little bit of the history. I didn't. I think I started at the very end of 18 or something. I can't remember when I started, 17. But prior to 2018, we had a very different investment policy, and it was sort of a very conservative portfolio coming out of the sort of the great financial crisis, and we were not delivering investment returns similar to the portfolio is now. There was a big revamp in around 2018 of the investment structure, and also I think the end of 18 was horrible for markets. I think the fourth quarter 18 was a bad quarter.
Thank you for taking that one for me. Here's where I was trying to jump ahead. I just didn't get far enough. So this is the determination of the actual determined contribution. So for 2023, the actual determined contribution was about 8.4 million. And in relation to that ADC, you put in the full amount. The difference in the net cash flow, again, just represents the slightly higher the additional payments that went in for that supplement. But when we look at where you are in relation to the ADC, we ignore that. So you put in the 8.4. The updated number for this year is a recommended contribution of just a little under 8.1 million. This is actually below what we had budgeted from last year, and that's really a function of the fact that we had the strong asset return over that annual period. So recommending a contribution for the fiscal year of, again, about 8.1 million.
With that was a good point or question, Trey. Maybe it wouldn't be bad to look at how well the portfolio did prior to the 2018 versus like a 70-30 benchmark compared to how we're doing now. I think with the old board, I guess, left a lot of money on the table with a very conservative investment strategy, because they were just, I guess, scarred from losses related to the 2008, 2009 timeframe.
Yeah, just to provide a little bit of context, I pulled up, I've got sort of the year-by-year plan year returns going back to 2013. So 2015, the portfolio's return was 0.2. 2016, it was 1.7. 2017 was 10.7, and then 2018 was 4.5. Again, Landon, to your point, portfolio was, I would say, uber conservative back then, given, the sort of the recency of the global financial crisis, I think was what the board was particularly concerned about. On top of it, that's about, the time that the big contribution for the pension obligation bond was a little bit before it, but having all that money come into the system and having another 2008 was something that the board was very concerned about, which is why it was invested conservatively.
Issued those, I think it was 200 million of pension obligation bonds, and then put it in the portfolio. It was like, let's just not lose the money that we just put in,
Yeah,
rather than,
exactly right.
looking for growth.
Yep.
Thank you, Brian.
And to be clear, it was before our time, so. But we do have the historical data.
Disclaimer there at the end.
This is the last slide I have. So this is a projection of contributions over the next 10 years. Trey, I believe you asked the question. This is based on those baseline assumptions, and that assumes 7.25 as a long-term assumption. As I mentioned earlier, what we see with the funded status is that spike in the actual determined contribution and the drop in the funded status is somewhat a function of the fact that the contributions are basically keeping that funded status level until we get to the end of the period. But the other driver of that, the short term, is as those losses from 2022 start to become fully recognized in the ABA, that's what's driving the slight increase in the actual determined contribution over the next 3 years until that levels out at about 9 or so million. And then the funded status, again, that'll basically we're maintaining that more or less with the contributions we put in the fund in the short term. As those benefit payments start to shrink, the contributions start to weigh a little bit heavier on the assets, if you will, and that's where you start to see those changes, the incremental improvements in the funded status at the end of the period. And if we were to project this out another, I think, 3 or 4 years, 2 or 3 years, to the end of that 12-year amortization period, at that time, under those baseline assumptions, we would see you would work your way to full funding once we get to the end of that period.
John, what is the average age now of a participant in the system?
I don't have new numbers. Last year I'd written down the average age of retirees under, I don't know which fund I'm looking at, 73-ish, I would say, 73, 74. I can get you a better number on what the updated number is, but one fund was about 75 and a half, and the other is 70 as your average age of retirees. Probably pretty consistent, maybe slightly higher, but say on average between the two funds, probably 73, 74. So as I mentioned, this is the end of the prepared remarks. In the appendix here, we do have the breakouts between the two systems. These slides, I should have said this at the beginning, I apologize, is the combined results of the two funds. The appendix has the results separately between fire and police and supplemental, if you would like to view those separately. But the commentary, I think, is consistent across the two plans.
So the 8.3 is the number for 2025?
Yes, the combined number.
Not including the 1,500?
Correct. Yeah. Yes, that's the other part of that, right. The supplement is not shown in here, and that's...
Okay.
All right.
Any
Do we
other?
have an electronic version of this? Can I get a copy of this deck?
Yes, I sent that to Stacy, but I can certainly get it. Okay.
Any other questions for John?
All right.
All right.
Thank you.
Thank you. Appreciate it. Any other questions, comments before we adjourn?
No, sir.
Landon, I do have one. Hasn't it been customary that information is presented to city council at some point throughout the year? And I don't know if that was done this year.
Yes, I think it was. I think it was.
Did you do it?
I didn't do it. I didn't this year. I have one time. I thought Brian.
We did it last year.
Oh, it has not happened this year.
The three of us were there.
I guess that's. I'm indifferent. I'll take direction from y'all if you think that's something that council wants and you recommend us
Beneficial.
to continue doing.
Yeah, I think it's beneficial, as the manager just mentioned, because we field a lot of questions around, particularly your piece.
Okay.
And so I think it would be helpful to have the stakeholders there and give a presentation to the council.
Does it and it makes sense to do that at the sort of the regular public meeting versus a work session or something?
I think work
Work
session
section
would
would
be better.
be, yeah.
Okay.
That's a
Would you
5
say
o'clock
public
meeting. Well, both are public meetings, but the work session is more of an informational type. There's no voting going on. This is just providing information to you.
Okay. I mean, if are you trying to do it before the end of the calendar year, or does it timing? How important is the timing?
Well, I think it should be annually, and obviously we did it in '23, but we haven't done it in '24.
When did we do it?
We don't have a lot of time left in 24.
We typically do it in November. So is there a meeting date?
26, is that right?
November 26th?
I'm not mistaken. I have to look to be sure, but I think that's the
That's
day.
the fourth Tuesday, yeah.
Okay.
And it's
yeah.
right in front of Thanksgiving.
Yes.
But it's the 26th is the fourth Thursday.
Okay.
You can either do it on the 26th or December, what's the second Tuesday in December? Those will be on two options that we'll have.
December the 10th.
December 10th or November 26th. So those are the two options we got. And either one works for me. I just need to know when everybody can,
Where's the work session in here?
in the chamber. Yeah.
Do you get questions at the actual council meetings, or like in between meetings, people are lobbing questions into staff?
About this, between meetings, not this. The only time we get a question at the council meeting is when one of the retirees show up and say, hey, where's my money? You know what I mean? Then we'll get questions, but other than that, yeah.
Okay. All right. Well, I guess we'll look to try to schedule that.
Okay, let me know what works. I need to know in advance, so.
One year we did it in here because there was 3 or 4 of us. And council members were sitting around here. I don't know if it was a work session or what.
Yeah, we've done it once here. We've had it where I one time at the public meeting spoke for a few minutes, and then I think Brian and maybe even Jim have done it without anybody from the board a couple times.
I think the best piece of it is to do
Yep.
your piece. And I'm not sure if you're going to present, it doesn't really matter who presents, but I think the piece of that most people are going to be interested in is that piece.
The liability stuff.
Actuary study.
Yeah, everyone wants to hear from the actuary, definitely. So,
Well, basically what most people are interested in is how much money does it going to cost me? You know what I mean?
Yeah.
Because, no matter what I deal with in the city, the first thing I got to do is turn it into a number. That number is how much it's going to cost me. So that's top on my mind. All these other things are really cool, and I'm interested in it. I got questions about it. But the main thing I'm really interested in, how much it's going to cost me.
Okay, we'll work on that, getting that scheduled.
Okay.
Anything else?
Well, just let Stacy know when that you guys can come.
Okay.
We'll need whatever presentation that you're going to present, probably
Week
3 or
in
4
advance.
days before. Yeah,
Let me
that'd be
throw
fine.
something on the table. Would it be appropriate to do it in this room and John goes via whatever we're using?
Virtual?
Yeah.
I prefer not.
I'm sorry?
I prefer not.
You prefer not?
Yeah, I
Okay.
think I would rather have it live.
Okay.
And in the council chambers, where not only the council members get to participate, but the public get to see it also.
All right.
Mr. Carter, I think what David was referring to, the work sessions used to be in here
Oh.
pre-COVID. That's what he's
Oh,
referring
I
to.
know anything about that, yeah.
Yeah, so that's all right. It's the work session
Okay.
he's speaking of, yeah.
So still the work
Yes.
session, David. It's just in the
Yeah.
council chambers. Yeah.
Just in there where you serve buffet.
You know, I'm still working on that. You know, I'm new as a deputy city manager, so I'm still working on it. You know. Yeah.
We have water.
But not much of it.
Yeah. We're rationing
We
that
won't
out.
spoil you.
All
Set
right.
expectations too high.
I think we can adjourn the meeting.
I think we probably already adjourned.
I don't know when you cut the video.
That's it.
Thanks, guys. I
Fine, good
appreciate
seeing
you.
Thank you, Brian. Thank you, Perry.
Thank you all.
Hey, guys.
Thank you.
Take care.
Happy Thanksgiving.